This program was made possible by the law firm of Zalman and Schnorman, whose practice is limited to personal injury and insurance law. Welcome to Lawline with your host, Alan Schnorman. Mr. Schnorman is a distinguished trial attorney, author, and lecturer. Each week, Lawline will bring you the most knowledgeable experts in the field of law today. And now, we introduce our guests and our host, Alan Schnorman.
Welcome to Lawline. W.C. Field used to say there are two things you can count on, death and taxes. Today we'll look at the importance of estate planning to save money on your taxes and the new tax legislation that was passed last year. Our guests are James Cohen, an attorney who specializes in estate and tax law, and Jerry O'Byrne, a CPA in estate planning. Hello, Jerry.
How you doing, Alan?
Okay. And James, let me ask you this. Estate planning, that's something for the rich, right?
Oh, no, I don't think so at all. I think that it's very important for most people to do estate planning, especially since, as a lot of people don't realize, you add in life insurance and all kinds of things that you add, and it very quickly adds up to a point where there can be a 55% tax.
Your real estate holdings, anything just gets piled in there.
Let's get to the basics here. Now, there's income tax. We all know that. That takes a piece of everybody's salary. And then there is estate taxes. Who pays estate taxes? When do you have to pay it? What's the story there?
Basically, estate taxes, it's really a transfer tax. You're passing on wealth from one generation to the next generation.
So first you have to have wealth.
You have to have some type of wealth. Minimal, maximum, some type of wealth. That wealth is passed to the next generation, and it is on that passing, that transfer of the assets, that the person transferring the assets is liable for the tax.
How much wealth do I have to have before or to be concerned about Uncle Sam and the states taking our money?
Today's $625,000.
Actually, as of this year, $650. Just
1998.
Right.
But if I have life insurance and I have a home
It's included.
and I have personal property and I have a few dollars in my IRA, would that also be included? My
Yes,
IRA?
every drop.
Yeah, in
Every
fact,
drop.
the IRA is taxed twice. It's taxed on income and on the estate tax, so it's even worse.
Okay, so let's assume with all my assets, I've been able to accumulate $1 million. I mean, it sounds like I'm a millionaire now. Do I have to pay the government taxes when I die?
You will have to pay taxes when you die. You will be able to transfer today, $650,000 of that will transfer tax-free. The balance will be taxed at graduated rates.
Now, when you say the balance, okay, how serious is this estate taxes? How much is
Well,
it?
let's talk about the highest rates. Okay, the highest rates are 55% for federal only. Then the
sounds like more
state
than income
gets
taxes.
kicked in.
It is. Oh, it's much
Well,
higher
more.
than it is higher than income tax.
When
So
you
you
throw
mean
the state
if
in, it's about 60%.
I've worked all my life, and let's assume I had a business, and a small business, but it was a successful business, and the business is worth maybe a couple of dollars. Would that also come into my estate?
Absolutely.
Now,
Although there is...
One of the changes in the recent law makes it a higher exemption for family-owned businesses if your close relatives will continue to run it after your
okay,
death.
And it's
so
for
therefore
10
if I give it to the
years.
kids, I don't have to pay the taxes?
Well, there are limitations.
That's why you need lawyers.
There are
one of those-
limitations.
Right. It has to be more than half of your estate in value. It has to go to certain people. It looks much better. We've learned this exemption looks much better on paper than it turns out.
And the
to be in
most
real
you're going to
life.
exclude is $750,000. That's the
Now,
absolute most
Jerry,
you're going to exclude.
correct me if I'm wrong, what both you and Jim do is prepare for someone's death to save them money on taxes.
Absolutely.
Okay.
Absolutely.
Now,
I wouldn't say
everybody-
we prepare for their death, but...
And in all
This
fairness,
really
we don't save them the money. We save their wife or their
But
kids
this is
the money.
really,
But
you call it estate taxes, but this is a death tax. That's what it
Yes.
is. When someone dies, the federal government can take, as you said, up to half or more than half
depending on your level of
of
wealth.
the assets that someone worked all their lives accumulating after taxes, by the way. Because this is
Absolutely.
money that they've already paid taxes on, income taxes
Correct.
on. And then the government gets you again.
And if you haven't paid the income taxes on it, such as Jim spoke before with the IRAs, you will then pay the income taxes on top of that. So
Let's
effectively,
stop for a second. So if I accumulated $500,000 in my IRA, I had it in the stock market, and my broker was terrific, and he made that 24 and 25% for 5 years. Not unusual. Can happen. And it's $500,000 now. But I pass away before I'm able to use that $500,000. Are you telling me first I have to pay income tax, then I have to pay estate taxes?
actually, it's the other way around.
But the answer
But
is
yes.
yes. Yeah, you get
Without proper planning.
You pay
What's left for my children?
about 30 cents on the dollar, thereabouts.
Without proper planning. That's the whole key to planning. Planning doesn't come after the fact, it comes before the fact. So you
Okay.
need to get in there and plan.
Now that we know we need planning, everybody wants, every viewer out there who's accumulated any type of money wants to know, how can I save money on my taxes? Tell me.
Okay, my best solution, my advice to everybody and anybody, spend your money while you're alive. Simple as that. Spend your money, enjoy your life.
Have your last check bounce.
Go for it. Go for broke. If you feel obligated to leave something, or you have enough to leave something, you can't spend all your money, you feel obligated to leave that to the next generation, then you have to go into an estate plan and start doing things.
Oh, I don't agree with that. I think it's harder than that. Nobody knows the moment that bell is going to ring. You got to have some assets around to look after yourself in your old age. And
I don't want
so-
to outlive my money.
Right, yeah, that's right. So that you really do have to, as a practical matter, if you've put together some money, leave some money.
I'd hate the thought of calling up my children,
Right.
asking them to support me. I know what the answer is going to be.
Right, exactly.
Well, I'd like to, but it doesn't happen. So
One-
give me the
one
keys.
good strategy.
What areas can we do? What can we do today to save
Lifetime
money?
gifting. Lifetime gifting
What is lifetime gifting?
The law allows you to transfer assets while you're living, while you're alive, $10,000 each year to each person, and if you're married, $20,000 to each person, so that
As many people as I want?
As many people.
Nephews,
They don't have
nieces?
postman, your mailman.
I don't think that's
That
gonna
is,
happen.
there's 5 billion
But-
people in the world. You could do that times 20,000.
But
Probably you probably don't care about all those people.
But realistically, you
If I
can give it
have-
to your children,
Your children, your grandchildren.
grandchildren as well. So
their-
what about
their
educational
spouses.
expenses for the grandchildren?
If you want to give education, if you want to fund their education, directly to the college. Do not give it to the children, because that will eat into the 10,000 exclusion.
So I can pay,
So that
as
if
a
I have-
grandparent, I can pay it, or even as a parent, just pay the fees to the college.
directly to the college.
And not
It
just
won't
tuition,
count.
but also books and other room and board, and that's also true of medical expenses.
Oh, so if
It
someone
won't
needs...
count toward the $10,000 exclusion.
Okay, so
each
this,
year.
all these things, what they're doing is, it's lessening my estate. I'm giving money away tax-free, as opposed to giving the government up to 55% later on.
You're
Right, and
transferring
and
it today.
I think even before you start giving it away, you want to have a pretty good plan for what you've kept. And for example, sometimes for some very simple changes in what looks like sleight of hand, little changes in paper, you get very different results. Life insurance. If you own a life insurance policy and it's payable to your wife, then she collects the policy. At her death, it's going to be taxed to the children at this 55% probably. If she predeceases you when you die, it's going to the children. It'll be taxed at 55%. But if you put it in a life insurance trust, it's going to end up being completely usable by your wife or husband or wife, whoever survives. And then whatever's left for the kids is going to go to them free.
It will not be taxed if it's in a
so
life
that's very
estate
important.
We're
trust.
talking about dollars instead of 50-cent dollars.
So if
for
you
the
have
children.
life insurance and you have substantial assets, you should have it in a life insurance trust.
That's correct.
That's a gimmick that the tax law allows.
Completely allows, clearly allows. Right.
So can I leave $1 million tax-free that way?
You
Yes.
can leave just about what people do with the life insurance trust is they fund for the taxes that are going to be owed on the estate. So if I have an estate, $20 million, and I know I'm going to owe $10 million of taxes to the government, and I want to leave that full $20 million to my heirs, I'm going to have $10 million worth of life insurance in a trust. That trust will come out, the monies will come out upon my death and pay the $10 million of tax. $20 million passes to...
Okay. Comment, personal residence trusts. What's the story there?
Cuperts, we call them. Qualified Personal Residence Trust. Everything gets a nickname or an initial.
Okay, what is it?
It's a trust that someone creates in which they retain the right to live in the house, which they were going to do anyway, for some period of time. And it's just a way of making an effective gift.
So my residence, if I take my own home
Yep,
and I put in a personal residence trust,
yep.
can I pass that over after a period of time to my children, estate tax free?
Yes, or certainly estate tax very much reduced. The value, let's say the value of your home is $1 million, and you keep it for the right to do that for 20 years. We'll make it up.
I want to live in it 20 years, and then
20
20 years after that, the trust gives it to the kids.
Right.
Correct.
Since the children aren't getting $1 million residence, they're getting the right to get this $1 million 20 years from now. You're treated as having made a gift to them of about $100,000, about a tenth.
Actually, it's a present interest of a future.
present
Yeah, it's
value
a
of-
present value of a future interest. That's right, and that's how it works. And because it works that way, you get taxed at a monumentally smaller
Can I
amount,
do
or
that?
none if it's within. There's another exemption we haven't even talked about, which is this once in a lifetime exemption that you. And if it's within that, you can have it be free.
Question, can I do that with more than one personal residence? Let's assume I have a number of personal residences.
You can do it with up to 2. And there's also, it's the residence and anything that normally would be used with it. So if it's the residence and there's some acres around it, I mean, it couldn't be thousands of acres in a little house, but I mean, you could do it with 2
What would be
residences.
stopping a person who's in their 40s of taking all their assets, let's assume they've accumulated $5 million, and it's possible in today's economic times with high-tech people and everything, and hedge funds.
Hedge funds.
$5 million, and they take it and they buy a house with $5 million, and they put it, a young person, they put it in a residential trust, and then in 20 years it passes automatically to their children tax-free. Would that be?
After that 20 years, you no longer own the house. Your kids own it. So first, you better be damn sure that your kids are going to let you live in it.
I was just going to say, you
Okay.
might get, on the plan that you just constructed, you might get hungry somewhere along the way, and say in the 10th year you might have to, I mean, you can't give somebody the stoop in exchange for
But let me ask you this.
some food, and also, though in the 20th year, there are 2 things. It used to be that you could provide, that you could actually buy the house back.
Can I rent it?
No, and those rules changed in 95, and now you can, but you can at least rent it.
So by renting it, I'm still giving money to my children.
That's correct.
Absolutely.
That's correct.
You're transferring more wealth.
That's correct.
But you better run for the gun, because the legislation that is proposed by Clinton is doing away with those, and
Because right
Congress-
now, it's a gimmick.
Yes.
It's a
And Congress
legitimate
has been-
tax gimmick.
the Congress has been limiting and limiting and limiting, and
Do you hear
eventually
this?
it will
If you
go
want to
away.
do it now. How else can I save money on my death taxes?
Let's see, we have...
How about, let's talk about gifts for a minute. After you've done, oh, I'm sorry, before we do that, let's talk about unified credit. That's very important. There's an amount you can give away for free. And you can give it away, the reason it's called unified is that you can do it during your lifetime or at your death, it doesn't matter. And that amount is now $650,000 per person. So I have a $650,000 exemption, my wife has a $650,000 exemption, and that exemption is increasing till in 2006 it's going to be $1 million. Each.
Unfortunately, it's increasing by little increments of $25,000 a pop each year
So
until...
if that's the case, if I have this up to $1 million eventually exemption, and my wife has it, if I die, shouldn't I give $1 million to my children, the balance to my wife?
Correct.
And then when she dies, because...
Almost.
And then she should also give
Almost.
them...
Part credit. Pretty good. That's a good plan, and it certainly will save. Think about it. Let's make the $2 million all phased in. So
I'm going to have to work harder to get all this money.
So it's 2006 or thereafter, and it's a 50% rate because we can do that on our fingers and toes. So it's $2 million. If you give everything to your wife and she survives you, and then she dies, she's going to have a $1 million
That's right.
exemption. She'll have to pay the tax on $1 million, approximately $500,000. On the other hand, if just as your plan was, you give $1 million to the children, or whoever dies first gives $1 million to the children, and then the survivor gives the $1 million to the children, then that's going to be free. You've saved the estate tax on $500,000 on $1 million, $500,000. But here's the problem. Your wife may not be able to live on the $1 million, and so there are ways that she can, in effect, rent that $1 million and not have it be in her estate at her death.
In other words, where she gets the use of the $1 million
That's right.
if she needs it,
That's right.
but it will not be taxed in her estate.
That's correct.
And that's what lawyers do.
And
That's what lawyers do.
Basically, what it's called is a credit shelter trust, where you set up a trust, you put the $1 million into it, the income goes to the wife, the surviving spouse, I should say, and the remainder goes to the children.
Jerry,
on her
let's
death.
assume that I'm a substantial individual, and I've made a couple of bucks, and I've already taken care of my kids. Can I give my money to the grandchildren and skip the kids? So therefore, my kids won't get taxed on it upon their death?
Absolutely.
Up to, well, there's a limit. It used to be, it used to be that all wealthy, really wealthy families only paid taxes every third generation. They would always skip. They would always skip a generation.
In other words, don't give the money to the children, give it to
right,
the
because
grandchildren.
the children already have it from the ones from before.
I like that.
And that was
Wasn't
a pretty
my
good.
case.
Was a pretty good. Well, it's not a lot of people's case,
Right.
but for the few people who are lucky enough to have it be
Right.
their problem, the government came along and said, "Gee, we don't like the way this works." So yes, you can give it directly to the grandchildren, or set up a trust for your children and then have it go to the grandchildren free. But it's limited to $1 million per person. So I have a $1 million exemption. If I can give my grandchildren $1 million. If I give them more than $1 million, there's going to be something
Taxes.
called another kind of tax, still a third tax system. We talked
I
about
love
the
it.
income tax, the estate tax. Now there's something called a generation
We're
skipping
going to
tax.
continue with this conversation right after the break. Learn how to save money on your taxes. You're watching Lawline. I'm Alan Schnorman, your host. Stay with us.
The air dances with the waters, which brings the rain that feeds the land, that is home to the animals. All life dances together.
In a world so connected, choosing one environmental cause can be hard. EarthShare is 40 environmental charities working together. You and your company can help by calling 1-800-MY-SHARE.
All life lives, or doesn't, together.
Excuse me, do you wear your safety belt?
Why, no, I don't wear my safety belt.
Thank you.
You could learn a lot from a dummy. Buckle your safety belt.
Hello, you're watching Lawline. We're talking about taxes. We're talking about saving you money on death taxes, estate planning. Listen, our guests are Jim Cohen, an estate lawyer, and Jerry O'Byrne, an estate planner. Jerry, years ago, I remember people actually went to other jurisdictions to save money on death taxes. People who've accumulated large businesses, so large wealth, they would move to places like in the Caribbean
Florida.
or, no, I'm talking about foreign countries, Bermuda. Is that still happening?
That's a big problem these days with the expats. People are trying to renounce their citizenship and leave the country so that their wealth is not taxed by the
Because
United
if somebody
States.
accumulates, these young people are accumulating $20, $30 million, sometimes even more. Now, I
Absolutely.
understand if you go to a place like Bermuda,
There's no estate tax there, and
I heard
there's lots of other Caribbean islands where there's no estate
No
tax.
estate
no
tax,
estate
no
tax.
death taxes.
No
I
death
like
taxes of any
Or
kind,
income
or
taxes,
income tax either.
for that matter.
But since the United States tax its citizens, no matter where they live, you have to renounce your citizenship, and even there is now a statute that will allow the IRS for a 10-year period to still treat you as if you were still a citizen. So it's not so easy. And then also, I've had a bet every year. Somebody comes into my office and says, "Boy, I'm gonna renounce. I'm leaving," and I bet each of them a good lunch that they won't do it. And I won the lunch 9 years out of 10. Unfortunately, I ran the bet 1 year too many, and one guy actually a year ago
So a
did
person-
expatriate. He really expatriated, and he went to an island. Yeah.
he goes to
Maybe the top 10 wealthiest people in this country will take that upon themselves to do it, but it's very, very hard to look yourself in the mirror and say, I'm going to renounce my U.S. citizenship.
Let me just ask you, so the people renounce their citizenship, I guess you send a letter, or whatever it is.
It's a little more formal than that, but it's not much more hard than
You
that.
go to the Caribbean island, where I assume you become a citizen of that island.
Yeah, you'd actually make sure you were a citizen there first. Yeah.
And then there's no estate taxes there. Now, here are some of these places like Bermuda have no income tax either.
Right.
So if they have accumulated all this money, there's no income tax on your investments. And then I guess that's the way they become.
But it's
super strong.
complicated. If you're in the United States more than a certain number of days, you're treated as a resident here.
Can you come back?
If you spend too much time here, more than a very minimal amount of time in the first year, and more than about something less than half a year thereafter, you will still get taxed here.
But isn't it interesting how people really avoid taxes,
Absolutely.
and that's how massive wealth is accumulated?
Yeah, though I have not found, I've found much more wealth being accumulated by good planning and staying here. There are not that many people, even very wealthy people, willing to run away from the place
How
that they,
else can we save money on these taxes?
Let's get back to the IRAs for a second.
Okay, good. Everybody has them.
That's exactly it. Let's talk about IRAs. Making somebody else the beneficiary of the IRA as opposed to your estate will at the very least keep the income tax portion away from your estate.
Really?
Okay?
Isn't that interesting?
So that if you make your children the beneficiaries of the IRA, they can take that IRA and roll it over into their own account and take it over their life expectancy. Okay, so you're actually
if you do it to your grandchildren,
borrowing.
if you do it with your grandchildren, they can do it even longer because
So
they're
let's
younger.
do that again. If you have an IRA, this is very important.
Absolutely.
Thank you. It should be payable to an individual.
Not necessarily. What if you're doing a charity? If you're a charitable person.
That's a very good point. Since the government is going to ultimately get about 70 cents of that dollar in the IRA or in the pension plan or the profit-sharing plan, the first money that goes to charity
should be out of the IRA.
Should be out of those kind of plans.
Because it's the highest
Because
tax.
it's the one that will save the most tax.
Now, people don't realize
Not because
that.
it's the highest tax, but because the charity won't pay tax
Any tax
on the
at all.
IRA distribution.
Right.
The income tax you're getting the
but
saving.
But the tax on that thing is the
Now,
highest level.
I am sure that my viewers are sitting there, and a majority, or 99%, have no idea that if they were to pass away, and they've accumulated a sizable amount, and they haven't used any of their IRA, or whatever they have left there, that 70% of that IRA will go in one form or another in taxes.
In fact, I can't tell you how many people have come in to plan an estate and there'll be a $10,000 bequest to their favorite charity, and their entire IRA goes to their children. And so if that $10,000 that's going to their children would be $3,000, if they just switched it around, there's a very meaningful savings.
Absolutely.
So there's just no reason to do it any other way, but so few people do.
Okay, so an IRA should be paid to the children or the grandchildren?
Yes.
Or if you're being if you are a charitable person
Or
and
charitable.
your estate is
Okay.
going to leave some money
But
to
never to your estate.
That's right.
That
Never to your
is
estate.
the last thing you want to do.
You might want to give it, I mean, sometimes you have to need to make your spouse the beneficiary because he or she needs the money to live on, you know?
Because that's your biggest asset
Because that's your
outside of
biggest
the
asset.
house.
Let me ask you this, wait a minute. I want to do estate planning. Do I go to my accountant? Do I need a lawyer? Who do I need?
You need both.
You're an accountant.
You need both. The accountant is normally going to know you more than anybody else,
Right.
more than your doctor, more than your attorney. They're going to know your every saving, your every investment. They're going to know you financially and personally, okay? The attorney is going to assist or work together with, not assist, but work together with the accountant to come up with the best estate plan.
And there are also documents to be drawn. That's never done by the accountant. It's always done by the lawyer. So it depends on it's generally a team. If, for example, the attorney will want to know what that business that you're running is worth, and that's something the accountant will have insight into. You
might do appraisals or valuations.
On the other hand, somebody's got to draw a will, and that's not going to be done by the accountant. It'll be done by the
trust
attorney.
documents.
My clients are always interested and concerned about attorneys' fees.
Uh-huh.
How much does an attorney cost? If I was interested in doing estate planning, what am I looking at?
Well, of course, the question you've asked is a little like, what does it cost to build a house? You know, is it a $5,000? Is a $5,000 square foot house, a 50,000 square foot house? Is it a building? You know,
But isn't there a range for
There's a
person
range.
who's accumulated maybe $1 million or a couple of $1 million?
Sure. I think a typical estate plan runs somewhere between, I mean, certainly $1,000 or more for a small estate, and as the estates get larger and the problems get more complicated. I mean, there are some very large estates in which the fees can be many, many thousands of dollars, but the savings are potentially millions of dollars.
Let's talk about fees in another aspect, though,
Right.
if we can for a moment, and that is the executive fees. When someone dies, they have to pay executive fees.
Right.
Well, before you die, you may make an agreement with your executor to set the fee. Otherwise, it's going to be a percentage of your
Or
assets.
is it usually 3%, 4%?
No, it's a declining scale, and it depends on the state. It's different in most states, but generally it starts at around 4%. It very quickly gets down to about 0.5%.
Now, we talked about tax savings and tax law changes. On the income tax side, the new law that changed, what did it do as far as education deduction, spousal immunity? Can you talk about that?
Absolutely. There are a few things that came about. Currently, before we get to education, if you have children, you're going to be allowed a $400 credit per child if your AGI is below, if your gross income is
Adjusted
below,
gross income.
your adjusted gross income is below a certain level. You'll be allowed a
What else?
$400 credit. You can put away $500 for each child into an education IRA. It is not deductible, and the limits on your adjusted gross income are low. But if you have an aunt or an uncle, or if you have a living grandparent that has very little income, you can gift them $500, let them put it into an IRA for your children, and that money grows tax deferred.
Quickly, what else?
There's some important changes for the fight when spouses are splitting up.
Right.
But they file joint returns.
Right.
It's been virtually impossible to get one spouse exempted from the other spouse's tax.
Right.
But the new law, under provisions that are too complicated to get into, but the new law makes it much easier for the spouse to
So if-
not get stuck on the ex-spouse's
If
taxes.
I'm a non-working spouse,
Right.
and my spouse who was working had me sign off on all the return all these years,
which you
and
probably never read.
and 5 years later they come after me for, I'm divorced now,
Right.
for tax deficiencies.
Right.
You're saying I may not have to pay them?
That's correct.
Yeah.
That's correct. If you
That's a
didn't
good law.
generate,
If you make an election.
if you didn't generate the income, you probably can get out of paying the tax.
Any changes in the IRA laws? Quickly?
Not that I know of. The Roth IRAs.
Oh, the
That's-
Roth IRAs?
The Roth
Yeah,
IRAs. Roth IRAs are IRAs where you can put away $2,000 a year each if you have earned income. If your adjusted gross income is below a certain level, it is not deductible currently, but when you take the money out, it is not taxable to you. So any earnings that grow will never be taxed. It's a total exclusion. You can convert
which
your
one is-
regular
Thank you,
IRA.
gentlemen. We'll have to have another show on more savings.
Okay.
Jim Cohen, thank you very much for
Pleasure.
being on Lawline. Jerry O'Byrne, thank you for
Thank
being
you
on
very
Lawline.
much.
And as always, this is Alan Schnorman. Thank you for watching Lawline.
You have been watching Lawline with your host, New York trial attorney Alan Schnorman. Mr. Schnorman will be back with you next week at the same time. If you have any questions about this week's program, please write to Lawline, 63 Wall Street, New York, New York, 10005, or call area code 212-432-9111. This program was made possible by the law firm of Zalman and Schnorman, whose practice is limited to personal injury and insurance law.